So your friend wants you to buy an IUL policy from him because it's the next best thing in insurance.
You are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. Today, we're talking about friends and finances. How do the two cross? Should they cross? Especially when that friend is looking to sell an insurance policy. And also coming up then, a question about Social Security from one of the listeners. Is it really going to be around in 20 years? Let's get started.
Well, I will say that a lot of our clients have become our friends. And some of our clients were friends before we started. But it's important that we understand all the details about any financial advice that we participate in, regardless of who it's coming from. Simply because it's a friend or a colleague, or maybe it's a client of yours, maybe it's a customer, doesn't mean that they understand all the needs that you have and the risks that you should or should not assume at this time of your life. So I'm particularly talking about a case that came across our desk recently where someone was promised $30-some thousand a year for the rest of their life when they retire if they will buy an IUL policy and pay $20,000 a year into it for the next 20 years.
Wow. So they over, 20,000 over 20 years, and they would have, $30,000 a year for the rest of their life?
Over $30,000 a year for the rest of their life.
Wow.
And this is a friend.
Well, that sounds like a pretty good deal.
That's a nice promise, but is that promise validated with facts?
So how do we find out?
So the real simple way to do this is to open the illustration and look at the guaranteed values in the life insurance product. This is true whether it's a whole life policy or a universal policy. Look at the guaranteed values because that is what the company is promising, is guaranteeing based on their performance.
Oh, so that's how this friend could promise it, is if it's promised by the company.
Only if it's promised by the company.
Okay.
Mm-hmm. And so as we scoot down this illustration, we see in year 20, there's only $43,000 that is guaranteed to be available in this policy at that time.
The IUL.
The IUL.
Okay.
So that would take care of that $31,000 in the first year.
Yeah.
21st year. Okay, now we can have 30. Oh, wait a minute. He said over 30,000 for the rest of his life. Does he know when this guy is checking out?
Nobody knows that, right? Only the man upstairs.
That's right.
The rest of this promise is coming from speculation. And why do we say speculation, John?
Because it's tied to the market with an index. Now, don't get me wrong, indexed universal life insurance products are not, you don't have to have a securities license. The insurance agent doesn't have a securities license to sell them. They are tied to the market.
Well, they're tied to the market because they mirror an index like the S&P 500. So if the S&P 500 goes up, your earnings go up. But in an indexed universal life, the insurance company sets a cap on how much you can earn when the index goes up. And that cap is typically around 10%. So I've seen some a little higher, some a little lower, but typically they're right around 10%.
And even if the market does go up by 10% this year, if depending on what's called a participation rate, you may not get to participate in all of that 10%.
Oh, now there's a good word, and it's often confused with the participation that whole life provides.
Totally different animal.
Totally different. The participation rate in indexed universal is the percentage of your accumulated cash value, or the money that you've paid extra for insurance that you really didn't need that year, because that's how universal life policies are built, on a term policy that they're overcharging you for. So money accumulates in this account where it can mirror a return from the S&P 500. So maybe you only allow 20% of that money to mirror the S&P. Well, that would be your participation rate. And so, depending on what your participation rate is in that index, will depend on how much you earn. It won't be 10%, 9%, 8%. It will be a variance based on what your participation rate was.
So you're saying the takeaway is that even though it's mirroring an index, you're not going to see the results of that index reflected in your policy.
That's correct. Now, in all good faith, on the other end of the spectrum, let's say that the S&P goes into negative territory like it has this year already.
Sure.
Well, there is a, quote, protection for that in an IUL policy. I usually see something around 1 or 2%. This particular policy only had 0.1% protection.
Ooh, ow.
Wow. 10
Now,
basis points.
Let's scoot back 10 years and look at the S&P 500 and what has it done. With those parameters, this IUL policy would have been capped out 10 times in the last 20 years.
Okay.
It would have only been saved 7 times with its 0.1% return rate.
Okay.
So it doesn't take a genius to understand that it would be better off for you just to take money and buy the S&P 500. You would have come out further ahead.
Yeah. And to get the guarantees,
and
get
to buy
something like
term-
whole life that's really guaranteed.
Sure.
Yeah.
Or buy term and invest the difference. That's what universal life products are anyway. They're just all packaged into one deal.
And fees added.
And fees added.
And fees added.
And you need to understand what the fees are. So the fees on this policy were 6% of what you paid annually in premium.
Ouch.
So what's 6% of $20,000? That's what went to the insurance company every year.
Yeah.
Unlike whole life insurance policy, which has a fixed fee that's flat for the rest of your life and is already included in your premium cost. So we can handle the fees part a whole lot easier in a whole life policy because we can project exactly what they're going to be. Mm-hmm. With the variable premium that you can put into an IUL policy, you don't know what that fee is necessarily going to be in any one given year today.
Right.
And that can be very damaging to your accumulation of wealth.
And what happens over the long term to the guarantees that are in an IUL policy? They don't stick around usually, do they?
Well, remember, it's based on an ever-increasing term product. Unlike whole life that has a level premium guaranteed for life that can never go up, but it could go down in the future if you opt for that. Universal life products have an ever-increasing premium. Now, you can pay extra in the form of a rider to protect yourself from that, but then that's just more money that's going to the insurance up front, whether you know you'll need it or not. Mm-hmm. And so it's important that you understand all the working components of this, because ultimately, universal life has no equity in it. Whole life develops equity. You actually begin to own your death benefit, and that's what's producing your cash value in that product. Whereas in universal life, you have no equity in the product itself. All you are doing is overpaying premiums and having kind of like an accumulation account or a savings account that is mirroring the indexes that index product can mirror.
Yeah. So it's really not even the same thing, is it? With the IUL versus the whole life. The agents try to sell them all the time. They say, well, IUL is basically the same as whole life. You have this guarantee, but you also have the opportunity to mirror the market. That's the selling point of it, right?
Yeah, that's what they say.
But even on the guaranteed side, they're different because of that term insurance.
They are different.
Versus the actual whole life insurance that the whole life insurance product is buying.
Well, and the participation in whole life, you need to understand, is your opportunity to buy more paid-up insurance. So now your death benefit grows over your lifetime, whereas in a universal policy, it doesn't unless you buy and pay for a rider that accelerates your death benefit based on like the consumer price index or the cost of living index or something like that. So everything that happens to protect you in a universal life process is going to cost you more, whereas those features are already built into a whole life policy.
Yeah.
So the longer we own a whole life policy that's participating, the more equity we have, because that policy, like a mortgage, becomes more paid up And eventually, when the contract matures, there will be no other type of insurance except paid up insurance.
Yeah. So we're talking about a lot of technical terms here. So as you're listening to this, you might think, well, this isn't something that I do every day. And it doesn't have to be. It shouldn't have to be. So we welcome, if you're listening to this, you can call our office, get a review of any existing policy that you have, whether it's an IUL, whether it's a whole life policy. And Mom, you usually talk to these people when they call in.
Yes, I do. In fact, the situation that we're talking about right now, the over 30,000 a year promise that maybe had no founding as we see, that was a listener to Wealth Talks, and he called in and he said, I hear you talk about whole life all the time. I would like to get your take on this policy. And then Tom, you designed a whole life policy using similar amounts of premium. And while this universal life had 43,000 in year 21, the whole life had a whopping 208,000. Those
Michelle,
are both
I just want to
guarantees.
interject here. It wasn't similar premiums, it was exact premiums.
Oh, exact premiums.
So we
Okay.
took the exact premium that was going to be paid into that IUL product and we put it into a participating whole life policy. And there was $43,000 of guaranteed cash accumulation in the universal life policy, where there was $208,000 guaranteed accumulated cash value in the whole life product.
That's
Yes.
a huge difference.
It's a huge difference. So then in year 21 on the IUL, the guaranteed value went to 0. In year 21 on the whole life, it did not go to 0. It was at 208 at year 20. It was higher at year 21. So huge difference there. And, when you've got a friend that's selling something, all the time women see this, especially where, a friend starts selling something, they have a little party, and you go and you support your friend, you buy some of the products there. You don't expect them to last a lifetime or to provide for your retirement or anything else. So, that's not a bad thing to go and support your friend. Hey, if you want to support your friend and buy a life insurance policy, I would beware of this universal life policy. Because look at the difference, 43,000 versus 208. You would be better just to find out whatever commission your friend's going to earn, pay them that commission, and walk away and go buy a policy that's going to really do something for you. Depends on how much you want to support your friend.
So for your information, I figured out the commissions that I would earn if I had sold that IUL policy. And it was $25,000 over about 10 years. I would have earned that commission. So just pay your friend $25,000, buy the participating whole life insurance policy. You'll still be way ahead, because that difference between $43,000 and $208,000 is a huge difference.
It's way more than that $25,000 you'll spend.
And that way you'll keep your friend, if that's the kind of friends you want to keep.
Yeah, exactly. And it's not that your friend is bad. It's just maybe your friend does not have the information that we have, at least I hope they don't, about life insurance, and especially about participating whole life insurance.
That's right. So give us a call to get your free policy review, 702-660-7000, or send us an email, team@life-benefits.com.
By the way, you will often find that agents that are selling indexed universal life don't want to show you the guaranteed values. Many times we have those illustrations sent to our office, and all they have is the non-guaranteed values. You cannot compare apples to apples until you see the guarantees.
Yeah,
And
so
of
a
course,
lot,
their line is often, well, the guarantees don't matter because the insurance companies usually do better than the guarantees, whether you're talking whole life or whether you're talking IUL.
And that's true, but we're talking about not the insurance company in an indexed universal product or a variable insurance product. We're talking about market conditions.
Exactly.
And so
And there are things that the insurance company can change in the fine print on many of those UL contracts.
There
That's
are.
what we can read through for you, get you the information so you don't have to filter through all of that.
yeah, and we can point it out using
absolutely.
the
We'll
actual
point it out
illustration.
for you.
You can see for it yourself. You just kind of have to know what you're looking for.
So picking your life insurance agents is kind of like picking a doctor. Do you go to your friend, the surgeon, when you need an appendectomy simply because he's your friend and he's done 10 appendectomies before? Or do you go to the specialist that has done thousands or at least hundreds of appendectomies with a 99.9% success rate.
I don't have any friends that do appendectomies. I'm not going to them. I'm not going to help them get like someone's going to hair school and you go and you get a haircut, or maybe you don't. I'm not going to someone like that for an appendectomy either.
All right. So we have another question that has come in from a listener on the podcast about Social Security. And we want to include that here for you. It says, I realize that Social Security, may not be there. I don't want to rely on it, but it's a system that's so colossal that it can't really just disappear. So should, my accountant, this guy's a business owner. So his accountant wants him to take a certain salary from his S corporation business. That's one of the requirements. So he is taking some salary. His wife, he says she's not contributing at all. Should I be concerned about this?
Well, 90% of Americans like you depend on Social Security for their retirement income. That's a huge number.
It is.
And especially when you consider the return on your Social Security contributions over the years, what kind of return are you really getting?
I read some research just the other day. It says the contributions versus what you get out, the average person is getting 1.23% rate of return. You could do that a whole lot better than that out somewhere else.
So this goes back to our whole philosophy
Security.
For you is that we want you to take responsibility for your own money so that you get to keep more of it, because nobody's going to take care of you like you can. Mm-hmm. And if we're depending on the government or anybody else to take care of us, it's not going to be at the quality that we're expecting or have become accustomed to during our lifestyle.
Yeah. So, for people that have contributed to Social Security, there are strategies that they can use to get more out of the system. They don't necessarily have to be concerned about not putting in, as long as you have the discipline to put it aside somewhere else, to do something with that money that's going to grow for you. Because, like you said, 90%, 9 out of every 10 Americans depend on Social Security when they get there. They haven't made that alternate plan.
And here's something you may not know, but is very important for you to understand early in your retirement planning. And that is that if you make over $25,000 in a year, your combined income in retirement, then you are going to be subject to taxation on your Social Security benefit anyway. If you earn, I believe it's $36,000 a year as combined income, then 85% of your Social Security payment is going to be subject to taxation. That is not often understood, so that's something you need to consider as well. So you don't want to be so dependent on Social Security that you're afraid to lose this money in taxation. You want to build up enough resources or passive income or some type of savings so that you do not have to worry about that taxation and you can live the lifestyle that you want to in retirement. And that's one of the reasons we like participating in whole life insurance so much, is because when you take distributions or with loans from your policy and distributions up to cost basis, that does not affect your combined income. Very different than a lot of the deferred retirement planning strategies that are out there.
Great point. Yes.
So then the more that we can get into life insurance, the more we will have there that we can use that doesn't affect our Social Security income or our taxes.
And what about Social Security being around, say, in 20 years? It's, is it so colossal that it's too big to fail?
I kind of agree with the author of that question, John, is that we have become as a society so dependent on Social Security, 90% of people are depending on it, that there would be a revolution, I believe, if all of a sudden those funds dried up. And so what I believe is going to happen is that the federal government is going to look for some other tax or some other confiscation scheme to be able to prop up Social Security for as long as possible. Now, we know what those there's been floated for years and years the idea to confiscate 401k plans and the IRAs that people have diligently put money into, because that's a huge chunk of money that hasn't paid taxes yet. And the federal government claims a right to that money because it owes taxes. So they could use that and develop some type of required contribution plan for retirement.
Yeah. It's often called the GRA accounts, the guaranteed retirement accounts, if you want to do any research on that.
And in that position, guarantees probably don't mean a whole lot.
Good point. Good point. Like guaranteed what, right? Guaranteed too big to fail by taxing the next generation.
Yeah. Oh, and options. Options. We need to keep our options open, as many as we can. Options of where can our income come from. So using life insurance cash values to purchase things that are going to provide passive income. That can be one strategy. Using even money outside of life insurance to start producing passive income, but keeping as many options on the table for us as possible. Also, covering spouses, covering each other with life insurance. Whoever passes first will leave an additional sum that isn't taxable to the other person that they can use in their life insurance, use for their lifestyle, that they can choose some other options to provide an income for them. It just gives more options.
The life insurance, not only does it provide those guarantees and those options, but you can access the money along the way. So as long as you're disciplined about doing that, so many more options.
That's
than
right.
Just putting it
And,
away into some program that you can't control, whether that's a 401k, a tax deferred, or whether it's Social Security, paying more than you have to.
And you're getting
Anything like
protection from the volatile market. So many people lost 50, 60, 80% in 2008, and just last year got up to where they were in 2007. That means they lost 10 years of their life in their savings.
Yeah, their life savings.
And this year hasn't been real friendly to people because we started out with a roar and now we're down under where we started in the markets. So that volatility is really costly when you were planning to retire in 2008 or retire this year when the market has gone below where it started. Life insurance protects that. That's where the guarantees come in.
Yeah.
And historically, those guarantees with life insurance companies are really, really valuable because
Better than Social Security.
historically they perform very, very well.
Yes.
So while we can make considerations like this, this listener was asking, what should I do about the Social Security? There's things we talk about here on Wealth Talks so that we can have a good picture of how things could look, but we can't exactly plan everything out because there are so many unknowns. So let's always think about making wise decisions with the money that we have, keep all our options open, or as many options open as possible so that we have a better future ahead of us.
Absolutely. You could run numbers until you're blue in the face. We could run numbers until we're blue in the face. As long as you have a range of what your options are, how many you can keep on the table, that's going to be the biggest factor. Because how do we know if all of those minute options that we could calculate out, how do we know which one is going to be there?
And when, just happening a month different
for everybody.
Could skew everything.
Yeah.
I remember, Michelle, when we were sitting in our CPA office, probably 15 years ago, and he sat back in his chair and he put his hand over on his 10K and he pounded out of numbers and he said, "Oh, you're going to have X amount of $1 million to live the lifestyle you're living today when you retire." And my question to him was, "Jim, how do we get there?" He says, "I don't know. I just thought you'd like to know the number."
Yeah, I remember him just shrugging his shoulders, and I thought, wow, how do we know how to plan anything if he's just going to shrug his shoulders?
And that's what I like about participating in whole life insurance. We can look at the illustrations and we can know this number is going to be there guaranteed for us 5 years, 10 years, 20, 30 years from now. It's going to be there. That's the contract. And if that company doesn't manage well and becomes insolvent, then there's the reinsurers of that company that are going to back that company up.
Yeah.
And
So as guaranteed as we can get on this earth, just about.
It is. And so if you're looking to know what your guaranteed numbers are, we'd encourage you to give our office a call at 702-660-7000, because some numbers are important to have today so that you can look to the future, to the end of the tunnel, see the light, and have hope, instead of just wondering if we're supposed to risk everything right now, cross our fingers, hang on, and try to enjoy the ride somehow.
All right. Well, a Merry Christmas to all of you listening to the podcast. And we'll be back here next week. You are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life.